we are honored to have here with us TAT Technologies. I would like to introduce Mr. Ehud Ben Yair, CFO of TAT. TAT is a strategic global partner to leading OEMs, airlines, maintenance organizations, air forces, and defense agencies, delivering cutting-edge solutions across thermal, APU, and landing gear systems. TAT has 12 million shares outstanding, trades around $34 for a $450 million market cap and $30 million of net cash for a $417 million enterprise value. Ehud will give a presentation and we'll do some Q&A.
Thank you very much. Does it work? No. No. Okay. How does it work?
Green is forward and then the little red one's back. I hope it works.
Okay, so quick. I have only 15 minutes, so it will be very quickly and concentrate. So TAT has been here for a long time, over 60 years right now, but in the last 4 years, something is very interesting is happening in the company. We are focusing on 3 major product lines. The first one and the largest one is the heat transfer solutions, in which we are an OEM provider to the major aircraft manufacturer like Boeing, Airbus, Textron, Embraer, etc. And we're also dealing with MRO activity for heat exchangers. Both our heat exchangers, also many others that are not being produced by us. This is actually 41% of our revenue. The second one and most interesting one is the APU. On the APU market, which is 27% of our revenue right now, but growing very fast, we are a certified repair station for all of Honeywell's APU, except for one APU that sits on Boeing 787. So we are covering all of Boeing platform and the Airbus major platform of the A320 family. And the last one, which represents 5% of our revenue currently, is the landing gear. Again, in the landing gear, we're only doing MRO services, and we're a certified repair station for both Gulfstream, for the G4 and G5 platform, for Embraer on the E170 and E195, and the ATR, all of the ATRs. In terms of our focus, so as you can see, about 70% of our revenue are coming from MRO activity and growing, and 30% of coming from the OEM. In terms of the company, we are really focusing on commercial aviation. We have some revenue coming from the defense side, which is less than 20%, and over 80% is coming from the commercial, but we are focusing on the commercial and trying to grow our business from the commercial rather than the defense industry. And in terms of geographical presence, about 65% of our revenues are coming from the US, 11% is coming from Europe, and the rest of the world is the rest. This one I think is the most interesting slide out of the 4 slides that I'm going to present. Shows what's happening with the company. So the company is really growing very, very fast. We build ourselves to a dramatic growth that came immediately after COVID for the commercial aviation industry, and the results are there. We're growing our revenue by 25 to 35% year over year, and we're really focusing not only on growing the revenue line, but also on growing the bottom line. So the EBITDA margin is growing about 50% year over year, and we are really very, very close to hit the 15% EBITDA margin that we'll hit at the end of this year. I don't have a slide about the share, but if you could see the share price, it went up in the last 5 years by 600% and will continue to grow because we have several major growth engines in the company. So what is really unique about us? So the company is really positioned to support the growth in the aviation industry, both OEM, with all the huge demand and backlog that Airbus, Boeing, and the others have right now for the next 10 years, and also the MRO. Everybody in our industry talking about MRO, lack of capacity, increasing demand for MRO services, and we're really well positioned and well diversified, by the way, both on the heat transfer, on landing gear, and the APU. We have shown the growth in the revenue, and we'll continue to show it in the coming year. Honeywell licensing. This is very important to understand the company and the potential for the future. As I said, we are licensed by Honeywell to repair almost all of their APU. We just penetrated the market of $2.5 billion annual revenue coming from MRO, from both the platform, the Boeing 777 and the Boeing 737, Airbus A320. We just started being active there, currently generating only several millions. You can count them on one hand or two hands, nothing more than that. And that's a $2.5 billion market that will support our organic growth in the next couple of years. This market by itself can double the size of the company in the next 2 years. Strong LTA, you can see here a graph about our LTA and backlog, which is right now above $500 million. Again, the combination is a little bit more than 50% is on the heat transfer solution. The APU is 27% and the landing gear are 12%. This is a huge number for a company that's going to end this year with anywhere between $180 to $185 million revenue. It's a very strong signal that shows how the company will grow. And last, we just raised close to $45 million from the US market in order to support the growth of the company, meaning that we're going to, the first time after 10 years, we're going to start being active on acquisition deals, and this will accelerate the growth of the company. In general, I would say that our strategic initiative is that in the next 3 years to become a company that with revenue of $500 million, 20% EBITDA, and a market cap of $1.5 billion. And I think we are well positioned to achieve this target. Now I will sit and leave the place for questions. Thank you.
That was fast and furious and very impressive to get through all that data in that short of time.
I don't have enough time.
And I apologize. Thank you so much for being, going along with that. I appreciate it. So you have a pretty interesting business. Could you tell me what your top strategic priorities over the next 2 to 3 years are? And then where are the most important end markets for drivers of growth? I know you mentioned the thermal APU and landing gear systems, but how do you sort of break those down or maybe line those up?
Yeah, so obviously we will, as we see it right now, as we were in the last 2 years, we're going to continue focusing on organic growth. The main organic growth driver will be the APU market. As I said before, and the numbers are showing it, we can double the size of the company within the next 2 years just coming from the APU. The landing gear MRO market is also entering now into 4 years huge cycles of overhauls, and we're well positioned there with 2 unique contracts that if you look at our presentation later on, you could see our product segment revenue, and you can see that we can double and triple the size of the landing gear activity in the next 2 or 3 years. So that's about the organic growth. By the way, the heat transfer solution will continue to grow as the OEM business or the aircraft manufacturer business continue to grow. I'm sure that most of you saw Boeing's and Airbus huge backlog for the next 10 years, and we're going to grow accordingly. Last is the M&A. We're going to start being very active on acquisitions right now in order to accelerate the growth of the company. This could, in our long-term strategic plan for the next 3 years, this can add another $100 to $150 million of revenue for the company.
It's a lot of opportunity.
Yeah.
Can you sort of talk about your backlog? I know we touched on it a little bit, but your long-term agreements, and help us understand how this is shaping visibility, and what does it mean for sustained growth in the coming years?
Yeah. So the backlog, as you can see on the slide above us, is actually a combination of 2 numbers. It's actually firm orders that we already received in order to either repair on the MRO side of business or OEM, and the value of long-term contracts. So in many cases, or I would say most of the cases, these are contracts under which we are an exclusive vendor. The customer is obliged to work only with us, to send us all the work, or for us to manufacture all the components that they need. These contracts are usually valued over the next 10 years, and the numbers are there. Now, if you look at the details of the number, it tells you that right now I have immediate work worth of $120 million, while I'm generating about $45 million revenue every quarter. So the meaning of the actual meaning of that is the LTN, the backlog, is so strong that this by itself, as it is right now, can support the very fast growth of the company. And obviously, as you could see on the charts, the backlog and LTA is continue to growing and will continue to grow in the fast.
Maybe just for a matter of time, I'd like to open up to the audience. Any questions from the audience? Okay, I got some more. You discussed a little about M&A. Could you talk about capital allocation, particularly given the recent $40 million raise you guys did? How are you looking to allocate capital going forward?
Yes, I think we are really on the first deal that we want to execute in the next 6 to 9 months. We were looking at about $100 million deal valuation, which will be served by half from the cash that we have in hand, and half will become from debt that we will raise in the market.
That'd be a pretty nice growth story there. Margin expansion, what do you look at as your target EBITDA, given your impressive growth in margins, margin profile target, and what are the initiatives underway to sustain that improvement and translate the top line growth into stronger free cash flow?
Yeah, that's a good question. If you look backwards to the previous quarter, so as I said, we're not only growing the top line, but we are very consistent on improving our margin, both the gross margin and the EBITDA margin. We put a target at the beginning of the year. We put a target to ourselves to reach the 25% gross margin and the 15% EBITDA margin. In Q2, we already reached this the gross margin, the 25% gross margin. We're still not there on the EBITDA, but we will be there on the end of the year. Now, the way that we are improving our margin quarter after quarter is coming from two elements. The first and simple element is that we are growing the revenue, and we're making sure that the fixed expenses are not growing in the same rate as the revenue grows. And the second thing is we constantly working on our inner efficiency. We constantly looking for places that we can do better on the three major product line in order to improve the profitability. And you can see it quarter after quarter. There is a long list of initiatives that we are managing, and quarter after quarter we finish some of them, and you can see immediately the improvement in the margin, and we'll continue to do it in the future.
It seems like you've got a pretty interesting business here, Ehud, and I think we're going to start seeing some good things from you guys as you've done before. But thank you for the time and great job, and hopefully get you back next year for some more time.
Thank you very much. Yeah, thank you, everybody.
Thank you. Thank you so much.
Tony Bancroft is a portfolio manager for Gabelli Commercial Aerospace and Defense ETF. Michael Bergio and Daniel Gleam are research analysts at Gabelli Funds. The above webcast is a recording from the 31st Annual Gabelli Aerospace and Defense Symposium, which occurred on September 4, 2025. GAMCO is providing these links as a matter of general information. We do not intend for these links to be a complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. As of June 30, 2025, affiliates of GAMCO Investors Incorporated beneficially owned 5.61% of Abdu Komen, 2.98% of Graham Corporation, 2.41% of Astrotics Class A and less than 1% of Class B, 2.37% of Moog Class A and less than 1% of Class B, 1.38% of Textron, and less than 1% of all other companies mentioned. The analysts' views are subject to change at any time based on market and other conditions. The information in this posting represents the opinions of the analyst and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Views expressed are those of the analyst and may differ from those of other GAMCO officers, analysts, other employees, or of the firm as a whole. Because the investment personnel at GAMCO and our affiliates make individual investment decisions with respect to the client accounts that they manage, these accounts may have transactions inconsistent with the information contained in this posting. Certain GAMCO personnel may know the substance of the posting prior to its posting. This webcast is not an offer to sell any security, nor is it a solicitation of an offer to buy any security. Stocks are subject to market, economic and business risks that cause their prices to fluctuate. When you sell shares, they may be worth less than what you paid for them. For more information, a prospectus, or summary prospectus, visit our website at www.gabelli.com or call 800 Gabelli 800 422 3554 914 921 5100 fax 914 921 5118 info@gabelli.com. Tony Bancroft is a portfolio manager for the Gabelli Commercial Aerospace and Defense Fund. This ETF is different from traditional ETFs. Unlike traditional ETFs, this ETF will not tell the public what assets they hold each day. This may create additional risks for your investment. For example, you may have to pay more money to trade the ETF shares. This ETF will provide less information to traders, who tend to charge more for trades when they have less information. The price you pay to buy ETF shares on an exchange may not match the value of the ETF's portfolio. The same is true when you sell shares. These price differences may be greater for this ETF compared to other ETFs because it provides less information to traders. These additional risks may be even greater in bad or uncertain market conditions. The differences between this ETF and other ETFs may also have advantages. By keeping certain information about the ETF secret, this ETF may face less risk that other traders can predict or copy its investment strategy. This may improve the ETF's performance if other traders are able to copy or predict an ETF's investment strategy. However, this may hurt the ETF's performance. For additional information regarding the unique attributes and risks of this ETF, see the Non-Transparent Exchange-Traded Fund (ETF) Structure Risk, Early Close/Trading Halt Risk, and Authorized Participant and AP Representative Concentration Risk in the Principal Risks section of the prospectus. Exchange-traded funds (ETFs) are bought and sold through exchanges trading at market price, not NAV, and are not individually redeemed from the fund. Shares may trade at a premium or a discount to their NAV in the secondary market. There is no guarantee the investment strategy will be successful. Investing involves risk, including the possible loss of principal. Premiums or discounts are the differences, expressed as a percentage, between the NAV and market price of an ETF on a given day, generally at the time the NAV is calculated. A premium is the amount an ETF is trading above the reported NAV, expressed as a percentage of the NAV. A discount is the amount an ETF is trading below the reported NAV, expressed as a percentage of the NAV. The prospectus/registration statement shows the frequency of distributions of premiums and discounts for these ETFs for the most recently completed fiscal calendar year and all completed quarters of the current fiscal year. Investors should carefully consider the investment objectives, risks, charges, and expenses of the ETF before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 800 Gabelli or visit www.gabelli.com. Risks to the ETF include a downturn in commercial air travel, production and/or supply chain disruptions, decreases in defense spending, subcontractor financial health, and competition and/or technology changes. As of June 30, 2025, the common stocks of Boeing, Ducommun, Curtiss-Wright, Moog, 5.55%, 4.54%, 4.26%, 3.69% of the fund's net assets, respectively. As of June 30, 2025, affiliates of GAMCO Investors Incorporated beneficially owned 5.61% of Ducommun, 2.98% of Graham Corporation, 2.41% of Astronics Class A and less than 1% of Class B, 2.37% of Moog, Class A and less than 1% of Class B, 1.38% of Textron, and less than 1% of all other companies mentioned. Distributed by G. Distributors, LLC, a registered broker-dealer and member of FINRA.